Just want to welcome everyone to our webinar today, the 2023 Crypto Investment Outlook, the most important themes emerging after our industry's most turbulent year. And with us today to speak, Marcelo Sampaio, the CEO of Hashdex, Mike Venuto, co-founder and CIO of the Tidal Financial Group, Chung, CEO of CF Benchmarks, and my name's Gerry O'Shea, the head of global content here at Hashdex. I'll be moderating this discussion. So before we get started, I do need to read a disclaimer, so please bear with me here for about 30 seconds or so. But this webcast is for informational purposes only, and nothing should be considered the official opinion of Hashdex, CF Benchmarks, or Tidal Financial Group. This presentation is not an offer to buy or sell, nor is it a solicitation of an offer to buy or sell. Certain information contained herein constitutes forward-looking statements due to various risks and uncertainties. Actual events or results in the performance of the products may be substantially different from those reflected or contemplated in such forward-looking statements. For any product-specific information, please refer to the appropriate prospectus. Great. So with that behind us, I'll go ahead and get started here. I think, we're about almost exactly 1 month past the beginning of the implosion of FTX. And I think there are obviously many questions that are unanswered at this time, particularly around what these events will mean for the crypto ecosystem, and more particularly for investors in crypto assets. I think it's pretty clear that pundits and skeptics of crypto have really capitalized on this opportunity. People like Paul Krugman to essentially paint the industry with a broad brush. And I think even though oftentimes these claims are baseless and maybe sensational, I think the past month has certainly added fuel to the fire for those that may be on some sort of anti-crypto crusade. But for most of us, I think we're anxious to do the work that's needed to repair this damage that's taken place in 2022, and really give investors the confidence that the long-term investment case for crypto remains fully intact, and kind of work towards that end. So this obviously isn't going to be an easy task, but I think our three speakers here today can certainly help shed some light on what to expect in 2023 and what these recent events mean for crypto investments or crypto investors in the new year. So I think I'll start with Marcelo. So Marcelo, this coming Tuesday, Hashdex is going to be releasing our crypto investment themes for 2023. And I was hoping you could kind of kick things off by talking a bit about what investors should anticipate going into the new year, especially in light of all of the FTX triggered turmoil that has really dominated conversations today. So I'll let you start with that.
Sure. Thank you, Gerry. So hello, everyone. Pleasure to be here. And it's a pleasure to see this year ending, I guess. It was a very tough year, not only for crypto, but for macro in general. Financial markets suffered a lot. But look, crypto, generally, I see investors focusing too much in price, which obviously has been, like I said, like a very challenging year. But and that fueled by the FTX debacle, which is still very painful for the industry right now. Ultimately, not necessarily a bad thing long term. When we see a bad actor leaving the market, but definitely very painful for now. But crypto this year in 2022, it was a very good year for crypto when we look at the fundamentals, the growth of adoption. When you take a look on things like the progress of the technology, or even some milestones in a number of jurisdictions in terms of regulation. So in general, crypto made a lot of progress in the year of 2022, and we believe this trend will follow. So 2023, we believe that a number of developments in the crypto space should take place. And because you mentioned FTX, we strongly believe that the FTX situation will push, if nothing, the regulators to actually act And we expect that to be in a positive manner. We don't expect that to regulators to come to with any super restrictive rules, but basically organizing the market and bringing some order to chaos, right? And pretty much allowing this market to develop. FTX should put some pressure, especially in the United States, to come with good answers in order to organize the crypto market. But in the technology, also, there's so much happening, like when we see like what happened with Lightning, really Bitcoin, creating, the avenues for scaling, really, we have like very material, data to show that this was real progress. This should continue in 2023. DeFi should get more and more integrated to traditional finance. We should see more cases in the NFT space, gaming companies bringing blockchain solutions, adopting blockchain solutions. Digital identity probably will take off. Social media, we should see something like around that. So without double clicking or going too much, in depth, we have all the reasons in the world to think that 2003 should be a great year for the development in crypto. It's hard to say how it affects price though in the short term, but still, there's a lot going on, and it's very positive outlook.
Thanks, Marcelo. I think it's a good kickoff to this discussion, and I'll turn things over to Mike now with a question specifically about Bitcoin, and in particular, I know we'll probably hear these three letters a lot during this call, but with regards to FTX and the fallout from FTX, what do you see in terms of how this potentially could change the investment case for Bitcoin? And maybe a second part to that question, the potential for a spot Bitcoin ETF in the US, where does that stand in kind of the wake of the news over the last month?
Yeah, so here's the hard part. The average, call it individual retail investor that's not familiar with, they didn't read the Satoshi white paper or any of that stuff yet. For them, FTX and Bitcoin in the media has become synonymous, right? So, I'm part of a community organization that, we give back and everything. And I go to these meetings, and there's, call it 50 people there that are all on average twice my age, and none of them know the difference between FTX and Bitcoin. They all just throw it into this narrative that it was all just a big scam. This is very unfortunate because FTX is the same scam that finance has been doing since the beginning of time, right? It has nothing at all to do with Bitcoin, zero, right? It was somebody trying to capitalize on the move towards decentralized finance by creating on-ramps for it in a way where he wasn't segregating anything. So there's a scammer, and then there's a amazing new technology that is going to change the way that we transfer data, that we commerce with each other, that we do central banking. It's so separate, it's unbelievable. So what has that done as an impact to the regulators? So I wrote the first paper I ever did on Bitcoin as an ETF was written back in, I think, 2017, maybe 15. Yeah, it was 15. And at that time, there was these two kind of news stories. It was the Winklevoss twins, right? And it was still Grayscale was going to convert. It's been that same story for almost 9 years, right? I took the stance back then that the Gemini Winklevoss concept, highly unlikely because they wanted it centralized to their exchange, right? We're way past that now, right? They gave up. They just want to be custody, right? And we've solved a lot of those problems over the years, right? We've dealt with the decentralization of where things are going to be custodied or how they're going to be priced, all that. And then you still have this narrative of Grayscale is going to convert. I'm being careful not to say tickers. So the irony is that Grayscale is going to convert story is part of why Three Arrows collapsed. It's part of why FTX is collapsing. It's part of what's going on with Genesis. It's this whole circle of actors that were trying to prey on this new technology rather than embrace it. So I'm giving you a long answer here, Gerry, so bear with me. I'm getting to some meat, I promise. All of these things would have worked if the price of Bitcoin and cryptos in general just kept going up. Like FTX wouldn't have collapsed if you would have just kept pumping new value into the system. This all was offshore. It was all there because the regulators weren't ready. When I talked about this, 9-10 years ago, I was very clear that I don't think the SEC, the division that approves ETFs, is going to be the one that speaks for the US government. I think that decision is going to come from a much higher up level. And then the ETF is a much smaller story for them. Right. So I'm very proud of what we've done with Hashdex and with Tucrium to get the futures into the right ETF structure in the US. We can get into structuring later and set it up so that in the future, when the larger part of our government, whether it's an administration issue, decision, or a Fed decision, decides how they're going to look at Bitcoin for tax purposes and tracking and all that sort of stuff beyond what they've done thus far, then it'll trickle down to the SEC, and then the SEC will look for the proper wrapper. I think we're well situated for when that tide changes. The retail pressure is off because of things like FTX, but it'll come back on because, I'm hoping Tim Draper's right, and that pressure will come right back if we hit his price target. I'm not going to reiterate it and get myself in trouble though. So there you go.
That's great, and I'm sure we'll talk again about Bitcoin later in the call, but I do want to turn things over to Sue for a minute to talk about kind of the broader crypto ecosystem. So kind of beyond Bitcoin. Marcelo mentioned some of the things that have developed this year and some of the things that we're anticipating developing next year around decentralized finance, digital culture, NFTs, all these kind of exciting spaces that have really been growing despite kind of the so-called crypto winter. So Sue, if you wouldn't mind maybe talking a little bit about the impact of kind of this year on those different themes and sectors within crypto, that'd be very helpful.
Yes, of course, Gerry. So yeah, I think I'd sort of echo what Marcelo said in trying to summarize this. It's been 2022 itself has been a big year for the underlying technology and the protocols. Remember, in 2022 we saw the Ethereum network move from proof of work to proof of stake. So this was happening live. The Ethereum network, they didn't shut it down for a couple of days to make a change. It was happening whilst the network was live. It is, from a computational perspective, by far the biggest blockchain network in the world, and it transitioned from proof of work to proof of stake and took with it all the various protocols, all the DeFi protocols, all the digital culture protocols, metaverses, all of them with it, right? And as it moved from proof of work to proof of stake. So I think that that was probably the single biggest moment in the past 12 months for the underlying technology. And what does that mean as we move forward into 2023? Well, I think it means that proof of work, that move from proof of work to proof of stake, number one, was only the first stage in the ETH merge, as the Ethereum network will go through a number of more upgrades to increase its throughput, increase its scalability, lower its transaction fees, etc. So what we're likely to see is all of those things that you mentioned, from DeFi to NFTs to metaverses that are operating on the Ethereum network, that they will scale up as those improvements to the network come through. So they will be able to scale up. So the costs associated, gas fees associated with conducting DeFi trades, DeFi transactions, for operating and maintaining assets in the metaverse, for minting and moving NFTs, all of that cost on the Ethereum network will be coming down. And so it's hugely exciting. It means, as as with all industries, once the unit cost of engagement or transaction comes down, so the amount of activity will increase. And the amount of activity increases, and so will the diversity of that activity. So I think we will see lots and lots of new DeFi applications. We'll see lots and lots of new forms of cultural expression on the blockchain. Just recently, we saw Nike release its NFT collection, expressing your preference for virtual sneakers is through the brands such as Nike. Is that something that everybody in the world will want to do in 2023? Probably not. But will a significant number of the 7 billion people on planet Earth wish to do that? Quite possibly, yes. So, it's a hugely exciting time. That underlying technology, as Marcelo said, the applications and how those applications will evolve in 2023 will be fascinating. That's why here at CF Benchmarks, we have developed our digital asset classification structure that allows investors to understand the various digital assets and the role that those assets play in what we call the blockchain economy, the Web3 economy, because I think in 2023, you're really going to see some of that. The end-to-end blockchain economy will start to emerge.
That's great. I think there's a couple questions that I'm thinking of specific to individual parts of the crypto ecosystem, but I did want to ask you, Sue, one question. You recently, I think a few weeks ago, put out a very thoughtful article about the FTX situation, essentially potentially driving institutional adoption, institutional demand for these assets going forward. And maybe before we get into those other crypto-specific themes, I would be interested in kind of you sharing that for the group here and kind of your thinking around that, why that is. I don't think there's many investors thinking in that way, crypto investors thinking in that way right now. And so if you wouldn't mind sharing some of your thoughts that you shared in that article, that'd be great.
Of course, not a problem, Gerry. So yeah, I think that when the FTX situation unfolded, I was sat in my office reading the news bulletins, reading Twitter, with ever less credulity. It was Kafkaesque the way it was unfolding on Twitter for a start. It was like some sort of dystopian future. It was you're watching it, you're reading about it, watching it through Twitter, and that agglomeration that Mike talked about earlier of a lot of people, for a lot of people, crypto, Bitcoin, FTX are interchangeable phrases. You could mash them up and add the word disaster, fraud, etc., and just come up with a headline. That was playing out. And so I was sat there and I was thinking, okay, just sort of close your jaw for a moment, Sui. Think about, okay, how is this playing out in the offices and halls of major financial institutions and major asset owners who obviously they're not crypto native. So this is certainly not water off a duck's back and just another challenge to be overcome for those who are in the industry. But at the same time, they are also more knowledgeable than the typical man on the street. They do understand. They certainly can abstract the difference between an asset class and a service provider, right? So if we think back to the financial crisis, just because Lehman Brothers collapses does not mean that all securities are worthless. So analogous here, just because FTX collapses doesn't mean that it says anything particularly about the underlying asset class. And so if you are at one of those major financial institutions, major asset owners, this happens. What are you thinking? You're thinking, well, it obviously is a space that is still lightly regulated and things like this can happen. So you're thinking that. And you're thinking that really that's fundamentally what stopped you from engaging your institution in that asset class in the first place. The lack of regulatory clarity. Now, because of some of the things that Mike said, obviously the FTX collapse is very high profile in the US. Marcelo mentioned it. It is likely to trigger serious regulatory action, serious consequences for the principles of FTX to prevent it from happening again. And so, and that will probably happen quite quickly. Because, as we know, Sam Bankman-Fried had a pretty high profile in Washington, so there is a degree of potential contagion for the political classes of the United States. And so I think that will happen quite quickly. And so once you have regulatory clarity, then for those major institutions, the biggest barrier to entering the space has been taken away. The biggest barrier that there is that lack of regulatory clarity. Exactly what am I allowed to do, and who should I be doing it with, and then to whom can I market this product and how? Right, the most basic elements of providing financial services in a market such as the USA. Once those rules of the road are clear, then you could either be, you could be a crypto evangelist. You could really believe in it and say, right, all that is clear. So, right, we're going. We're going to go and do this. Or you could be relatively neutral and just take the attitude of, if there's client demand, we're here to fulfill it. And I think in either case, the net result is that you will, you're in that institution. All those institutions will start to offer crypto products or crypto exposure. So that was the gist of the thesis. And I think that it's interesting that some, CEOs of very large financial institutions in the wake of FTX have been vocal about their belief that the technology, they don't use the word crypto, I don't think, digital assets certainly have a big part to play in the future of finance. And I think that those individuals would not have said what they said if they didn't think that regulators are soon to give them, the rules of the road for engaging.
I'd like to jump in on that just for a second, because I want to hit two words that Sue was putting out there. I love that you said regulatory certainty, right? Because it's not that we all want to be regulated. We just want to know what the rules of the game are, right? And I think this is where the US has made the biggest mistake, right? So, I think last year, 25 billion went into venture projects in blockchain, right? Because you know why? Because they couldn't buy Bitcoin, right? And they couldn't buy crypto. So they wanted to be in this space. So they invested in private companies. Even Q1 of 2022, here, I got this stat, 10 billion, 2022, this year, this bad year, still 10 billion went in Q1 into private ventures in the blockchain world. That money is going there because people don't have regulatory certainty on how to buy Bitcoin. Imagine if 10 billion went into Bitcoin in Q1. That leg up a couple of years back from, on a 3,000 to 20,000 was off of $20 billion moving around. So that regulatory certainty is definitely the biggest hurdle. That is the reason why Michael Saylor's the only one out there willing to put this on his balance sheet, right? Because he puts this on his balance sheet. Not only does he have tax headaches, he's got accounting headaches, he's got all kinds of things, and he still sits there and holds and preaches. It's amazing. The irony is, if he held it in an ETF, he'd have none of those problems. He'd have none of this mark down the market. He'd have none of the tax headaches. So it's that lack of regulatory certainty that is holding us back and has probably been the biggest cause of the extremeness of this winter, because it invited all the bad actors in from traditional finance. So I just had to get in there and put a stamp on what you said there.
Yeah, that's a great point. I think it's actually a good segue for my next question, which I'll direct at Marcelo, but then Mike, I think you'll very obviously have some thoughts too. But so crypto investors right now, right, have gone through this experience of 2022 and the last month, going into 2023, especially in light of the kind of regulatory uncertainty that we were just talking about, Marcelo, what should investors be asking of a crypto asset manager? Like, I know we've spent a lot of time talking about our operational processes and things like that. And the reason I also want to pull Mike in as well is because I with ETFs, right? This whole thing is in some ways been an advertisement for the benefits of an ETF. So maybe Marcelo, if you could start, and then Mike, you could chime in specifically about the ETF structure. That'd be great.
Yeah, sure. This has been a very hot topic for the industry right now, especially for us as a regulated asset manager in the crypto space. Definitely investors should be very careful, like, and diligent in like asking for transparency, for any player, basically anyone that they'll be touching on crypto. The problem that all the problems that we had this year, and I would even say that even more than this year, like in the recent past, we're tied to the lack of transparency, right? Really, which is a byproduct of lack of regulations ultimately, or this like regulatory certainty. But ultimately, what investors should be asking is that what is exactly the how can I be assured that you have the assets you claim that you have, how can I be certain that you not disappear with my money, and you have a number of ways of do that, so we can talk about very specifics around segregated custody, and so on. But ultimately, I think that the game will be played around choosing well who you want to partner with, assuming that as an investor, you don't want to deal with all the hurdles that crypto brings, right? If you invest in crypto, you need to, if you don't want, to use professional management, you need to custody yourself. You need to take care of taxes, and all this is pretty complex for most people. And I always ask that, I have this, this harder wallet. So you hear a lot of those things in the space, and I always ask, say, great, are you confident of investing $1,000? Yeah, sure. I will do this and that. What about $1 million? What about 10 million? What about $1 billion if you're institutional investors? And Gerry say, no, you can't do this. So professional management has a place, and really is pretty complex, and it's a hard job. But as an investor, you should really, do your due diligence and with who you want to be working with. Really do this, and it will pay off. At least you'll not be involved in the FTXs out there. I don't know if Mike wanna chime in and
I mean, so to me, this is the jumbo shrimp of crypto, right? And blockchain, all this stuff. What I mean by jumbo shrimp is Bitcoin was created to make it so you could bank yourself. Bitcoin was created to replace the trusted third party. So I'm here as a business owner, being a trusted third party on all kinds of things, on over 5 billion in assets and 60 different ETFs we touch, right? So I am a trusted third party. Bitcoin and the technology behind it over the next 50 years should replace most of what I do in my business right now. What am I selling as a businessman? I'm selling two forms of trust. I'm selling the trust that I can verify your transactions, and I'm selling the trust of the advice on what the transaction should be. I think over the next 50 years, that first part of my job or entity or company, if I'm still alive, is going to go away. It's going to go on to the blockchain. And the second part will become even more valuable because people will want to pay for people to tell them how to use things. That's the investment management of Hashdex and the indexes and the things that they've created. Now, the first part is, an ETF wrapper or whatever wrapper to work with an asset manager to get access to it. In my opinion, in that scenario, you're not really working in blockchain or working with the protocols. You're wanting to participate in the price movement of the future of finance and the future of technology. Fine. if you're going to do it that way, you're going to trust a third party, right? Like, if you're not going to bank yourself, you're going to trust a third party. If you're going to trust a third party, make sure you know that they're as much as you can about how they're segregating accounts, right? FTX blew up, not because FTX sucked, but because it was commingling all of your money that you put on there with their hedge fund and buying a bunch of other bankrupt companies. Like, it was crazy. So know the custody, know how it's being segregated, know all those fun things. The laws that govern the idea of an ETF come from 1933 and 1940. They did not ever envision the idea that there could be something called a digital asset, right? Number two, they keep trying to stick new things into these ideas. So where are we today? Today, those laws are the laws. They're not going away. It's highly unlikely they're going to change them. But there is one beautiful thing at the core of those two laws, and it's disclosure. If I've got a conflict of interest, I've got to disclose it. And I got to do it over and over and over again. Heck, Gerry spent 3 minutes reading one at the beginning of this call, right? Like, so that does not exist in unregulated businesses. SBF, Sam Bankman, whatever, scammer, he did not have to disclose that he was taking your money and spending it to buy other bankrupt companies and make political donations. That was not required of him, because rather than regulate Bitcoin and put it into the 40 or 33 Act structure where it belongs, our government chose not to say anything. And so then people went offshore. That's where we are. The disclosure, transparency, liquidity of the ETF structure brings so much light to this. And it's the road, it's the collaborative, disruptive road to blockchain, Bitcoin, crypto, truly replacing a financial system that is overly centralized and full of conflicts of interest. There's my speech. I'll get off the soapbox.
Well, I was going to say, so that's actually that again is kind of a good segue to where I want to go next. And I should mention too that we do want to save 15 minutes or so at the end of this call for audience questions. So please feel free to submit them if you have them. We have a handful of them coming through already, but regarding kind of the centralization question, and I think this is probably best directed at Sue, but the DeFi protocols, and one of Hashdex's themes for 2023 is kind of the continued strength of kind of the blue chip DeFi protocols. I'm thinking of Uniswap and others and their performance, but I do want to kind of maybe look back a little bit over this year. And maybe, Sue, if you could talk about the strength of DeFi protocols, maybe compared to the way some of these centralized institutions have performed, I think that'd be helpful discussion as well.
Yeah, sure, Gerry. So, with DeFi protocols, which are effectively software code living on smart contract blockchains that initiate and conclude transactions that are analogous to transactions that we conduct through centralized financial entities. So you mentioned Uniswap. Uniswap is the biggest DEX, decentralized exchange. It's a bunch of software code that basically allows peer-to-peer trading of assets. So it's basically an exchange, but it doesn't have any operational staff. It doesn't have a big fancy building on Wall Street. It just lives predominantly on the Ethereum network. And this year was, a pretty, even taking into account the slide in asset prices, the big protocols, those blue chip protocols, as Marcelo calls them, had a very strong year in terms of fee generation. So the top 5 or so DeFi protocols generated in excess of $300 million in fee revenue generated this year. So, because to use these services as a user of these decentralized financial services, you do have to pay. do have to pay to use the protocol. A small fee is charged if you wish to make a trade on Uniswap. Another major protocol, another one of the blue chips, Aave, which is a protocol that allows for borrowing and lending. So it's a lot like a peer-to-peer lending platform, but there is no company there. There is no lending club. There is, there isn't that entity there. It is, again, a bunch of software code residing on the Ethereum blockchain, and in fact the Solana blockchain in Aave's case. These Uniswap, Aave, Maker, these protocols have generated significant fees. They have what is known as TVL, total value locked. So this is the amount of value that is locked inside their systems. That is in excess of $10 billion. So it's all, and the activity is not sporadic anymore. It's pretty much happening 24/7. It's happening constantly now. And so so that's what happened this year. And then if we go into 2023, I think that I very much share Marcelo's sentiments that the blue chips, those Uniswaps and Aaves, that have become within the blockchain Web3 economy, they have become utilities. They have become the de facto place to undertake that type of transaction. If you wish to trade, if you want to swap one asset for another asset, it's you just go to Uniswap. And there are other protocols, what we term actually DeFi wealth managers, right? There are other protocols that have been set up to optimize your experience of trading on Uniswap, effectively acting like a smart order router in our traditional financial system. Similarly, yield enhancement strategies, yield optimization strategies in the form of software protocols that are transacting on Aave. So yeah, it's been a pretty strong year for DeFi adoption and continued growth in DeFi. In 2023, I think what we'll see is those what we term the big DeFi utilities really cementing they have cemented their position. They will spin up new products and markets, and the network or the ecosystem of protocols that are designed to optimize user experience on those utilities will continue to grow. So hopefully that will mean that the fundamental user experience for the end user, that there's more competition around that, so that transacting through DeFi becomes a little easier for the uninitiated.
I would just add 2 points, so fantastic. We're very aligned with this vision. So I would add just two points into DeFi here. And one is that, like we have been saying, this was a hell of a year, right? And DeFi worked fantastically. This is very important to say that, it liquidated, processed every single transaction that was there to liquidate and transact. And we know it's outside support, really, in an auditable manner, very transparent, very predictable. What failed was really the centralized system, not the decentralized one. So DeFi really, worked beautifully, right? So this was point one that was important to say. So point two is that digital assets in general, and it's going to be a hard statement that I'm going to make here, but it's maybe from non-digital assets, it's maybe the difference of handwritten letters to emails, right? It will eventually happen. So the hard statement is that I would say that in the future, and we don't know if it's in 10, 20, 30 years, less or more, all assets will be digital. Not because I want, not because I think it's cool, not because of the libertarians out there, just because it's way better. It's not a little bit better. It's an order of magnitude better. So imagine now you can digitalize your house, right? Why do you need to own 100% of your house? Maybe you just need to own 51% of your house, just like you own companies, right? And maybe have like 1,000 investors that will love to have like financial interest in that specific neighborhood, or So just small example, but every asset should potentially, or is bound or is poised to be digital eventually. And they'll be traded using DeFi very likely. And just because DeFi has no borders, right? And whenever we're talking about trading, volume plays a huge like a role in this. So more volume you have, more efficient networks are. And if US now is the largest capital market in the world, like larger than US is the whole world, right? So what I'm just saying is DeFi has a great potential and will keep progressing. 2023 for very specific reasons, and so you mentioned a number of them. Like will very likely be a good year to DeFi, but cooler than 2023 is the next 10 years. The next 20 years, we're going to see a lot happening in this space.
So we've got just about 12 or 13 minutes left, and we've got now have a lot of questions that have come through, and I do want to address some of those. I think the first one is probably for Sue. It's around there's a handful of questions about NFTs, but the question is basically, with the kind of euphoria around NFTs having cooled a bit this year, and I know you mentioned earlier some of the partnerships that have taken place, but are you anticipating that these types of partnerships, things like FIFA with Algorand and some of the others you mentioned, are you anticipating this to continue in 2023, or do you think because of the current environment, some of that work will also kind of cool off?
No, I think that here we will just see more and more of the same, probably at a faster pace, because fundamentally, NFTs are a means for many things, but for existing brand owners and existing content owners, existing IP owners, they are just another avenue to exploit their brand IP, their intellectual property value. So they are not going to leave any stone unturned. Right? When you are a soccer club with 1 billion fans worldwide, whether you're a sneaker brand who sells 50 million pairs of sneakers a month, the opportunity to generate more engagement, more revenue, and ultimately increase the value of your brand IP through a new channel of engagement, you're going to take it with both hands. So I think what we've seen is merely the beginning, and we'll see a lot more. I think that what will, for me, probably the most interesting NFTs, the most interesting dynamic that's out there in terms of digital cultural artifacts is this notion of community, and it's very interesting what Bored Ape have done with, they seem to have built this, and theirs is native. Let's remember, theirs is completely native to the blockchain. So the Yuga Labs, they created these Bored Apes, NFTs that are very valuable. They then have effectively, through the ownership of an ape, effectively it makes you a member of a very exclusive club. And this exclusive club has all kinds of benefits, including an airdrop of their subsequent token, ape token. And then ownership of ape tokens gives you access to a slightly less, quite a lot less exclusive club, but it still has other benefits that are both in the metaverse, but also in the physical world, in the physical real world. They have a clubhouse. There are physical. They put on physical meetings that only holders of the NFT can attend, etc., etc. And I think that template. I think what we'll see is traditional brand owners, IP owners try and copy at least elements, if not the whole thing, and try and implement it for themselves. Because, for a lot of IP owners, the different ways that you can engage with the brand are still very limited. So if you're Louis Vuitton, you can have someone can see an advertisement, someone can go and buy a handbag, right? That's a $6,000 gap. Surely there's a gap, you know, so you can fill that gap. Surely there's a $1,000 price point, right? If you're at Louis Vuitton, you're thinking there's got to be, what can I create that I can sell for $1,000 that is going to further my brand, deepen engagement, get someone closer to buying the $6,000 bag? And NFTs and digital artifacts, blockchain artifacts are an intriguing way to try and create that. So if you think about, you know, from, you know, today you can either go and see Katy Perry in concerts. I don't know how much that costs, but probably about set you back about $1,000 and sit in a very long queue. Or you can buy, you know, you can subscribe to Spotify, you know, listen, stream the music like a billion other people. Again, is there somewhere in between, right? So I think that's going to be a very interesting space to watch in 2023 and beyond.
So I think this next question shifts gears a bit. It's more specific to kind of crypto in portfolios. And the question is around crypto volatility in relation to my portfolio. I don't want to catch a falling knife, but there are a lot of seemingly opportunities with current prices out there. So I think that the question is really around how to think about the current volatility within a broader portfolio. So I don't know, Marcelo or Mike, feel free to jump in.
I can definitely jump in, but you know, like we have Mike here who has been doing this for his entire life, so I guess I'm a bit shy to run, but I can definitely jump in if you want. But Mike,
you go first, and then I'll back clean up.
Yeah. So the way I would say is the following: it's very hard to predict, you know, like if we're at the bottom, if it's gonna go more or less. But the truth is, you know, like the crypto case is super strong, especially when you understand what's going on, you know, like really around the technology and adoption and so on. We don't have. I generally say that as of now, at this moment in time, we don't have a consensus for most blockchains on how to value them. Right. So what I'm trying to say is this, you know, like valuation, we don't think like that, but valuations are consensus in general. So I always ask people, did options have prices before Black-Scholes? Right. So yes, of course. Right. But eventually, you know, like generally coming from the academia, you have like some people proposing some models, based on math, you know, like and start resonating with a bunch of people, and eventually it goes mainstream. And we start like turning to that to value a specific asset or asset class. In crypto, we don't have this consensus yet. The books are yet to be written. Like we need more time, right? But whenever we go top down, we just compare like a specific blockchain try to solve a specific problem. In general, you know, like the security margin is so big because if this blockchain just captures a little bit, right, of the value of the way this problem is being solved today, it's a lot bigger than it, you know, like than the price of today, even at Bitcoin at $70,000, right? So what I'm trying to say is, instead of trying to predict the bottom, you know, like buy and hold for a long time, a little bit. Don't go crazy. Don't put like 80% of your assets on that. You know, like a little bit, and you're gonna know what little bit is. We generally recommend to our customers, to our clients, our investors, like something to start like with 1-2%, but then you're gonna know what is your number over time, more you get involved. But it's a little bit for a long period of time, because crypto delivering what, you know, like it more and more, you know, like seems to be the case, you know, like should be bigger, a lot bigger than its size, you know, like this time, even with the market falling a lot.
All right. I agree. I want to start out by talking about the transparency part, because there's what I would recommend to people and what I do for myself. And I want to put both out there, because I think that's how you gain trust, by letting people know what you do. Right. So, there are two ways to invest. Well, there's many ways to invest in this space, but there's two philosophies about investing in this space in my mind. So there's philosophy number one. It's an investment. So you really just put it into a Monte Carlo system or whatever, and you say it's 1-2% of your portfolio and rebalance. That's pretty straightforward and simple. And Hashdex and many others are working on great solutions to get you those accesses. Then there's this other philosophy that I call buy and learn. If you're buying these things directly, the actual protocols, the types of things that Sue was going through, and then you're learning how to move them to a cold wallet or move them to MetaMask or mint your own NFT, or, like, to me, that's buy and learn. And whatever you put into it's going to likely cost you less than paying for an education in this stuff. And sometimes you get lucky. Like, I mean, I've gotten lucky on some of these, but I've learned a lot more in terms of value from the actual process. And working with my team on we created an ETF nerd NFT. Figuring out how to give that away for free was really freaking hard because the systems aren't meant to be free, right? Tiago, our tech guy, I can see he's on here, and I put him through the ringer figuring that out. And then, so I like the buy and learn, and as my approach. So me personally, like, I have 60 ETFs. Some of them touch this, like the Hashdex one that we did. Some of them do equity, some of them do all kinds of things, but all of them are transparent. Everybody can see what we're doing. And then my own personal account, I have a Gemini account that's tracking a Hashdex index because I want to be good partners with them. That's where I get my weird stuff. And then I have a public account. Public is a app that lets you see what somebody's doing. So when I go and buy Hashdex ETF, you can see it, right? And I pretty much buy every day something. The hardest part for people who become investors in this is that price volatility. And it's not just to the downside. Because when it goes to the upside, if you're just an investor and not a buy and learner, you've got to sell. Meaning, if it goes from 2% of your portfolio to 15, which has happened to many people multiple times, and then they don't sell and then they go. So you either have to be an investor who's buy and rebalance, or you have to be a learner who's buying and learning. That's how I look at it.
I love that. And
if you're going to buy yourself to learn, just do that with little money, guys.
Yeah, little money. Yeah. Yeah, I mean, look, how many people have lost crypto the first time they tried to move it from one place to another, and then they realized they moved it to some VPN somewhere, and like moving it to a cold wallet. Like, yeah. I've got 4 of them, and like, I got, being your own bank is hard. Minting your own NFT is hard. Doing your own swaps is hard. It's why interns at Jane Street make 300 grand because they're banking for you.
In a terrible way, a lot of people graduated with the FTX case, right? I mean, yeah. I was there for Mt. Gox. I was there for Cryptsy, and a number of them. So I guess my lesson, I think the only difference is that was like what, now 7 years ago, more. But yeah, that's do that with little money. That would be my. Or if you want to really invest, trust, like a professional manager to do that well for you for the right price, like with all the tools and everything. So that would be my recommendation.
I think that's as good a way to close as possible. So we're right at time. And I just want to remind folks, as I mentioned up front, that Hashdex, we're going to be releasing our crypto investment outlook next Tuesday, the 13th. So that'll be on our website, hashdex.com, on our research center. But thank you all. This was a great, robust discussion. And I'm sorry we don't have more time to continue on, but thanks again for everyone's time and joining. Appreciate it.